Today we have a great program for you, Fundamentals of Property Finance, delivered by Dr. Jeffrey Fisher. Dr. Fisher will cover a broad array of topics, and we'll be covering that in about 40-45 minutes. But throughout the session, you'll be encouraged to voice any questions or information that you'd like to hear more about through the chat box in the lower right of your screen. Type in your chat message, and we'll do our best to get to that question either right on the spot or at the end of the program. And of course, if you have further questions at the end of the program, we'll be delighted to assist you, and the presentation will be available for download, and we'll send you information and provide information during the session as far as a link to that information. My name is Jeff Finn. I'm CEO of RealNext and delighted to host you today. RealNext has brought together a powerful suite of technology tools for the real estate industry that can both help you in your financial analytics as well as your full deal automation, bringing you from CRM and property information management to transaction management, financial analytics, presentation, marketing, and through the closing process to increase your productivity, efficiency, and profitability in the commercial real estate industry. Certainly, we'd be delighted to show you more and talk to you further about the RealNext products at your convenience after the program. But for now, we'd like to get started with the fundamentals of property finance with Dr. Jeff Fisher. Dr. Fisher is the Professor Emeritus of Indiana University, wrote the textbook, leading textbook on real estate finance used at many universities in real estate programs throughout the world. He is president of the Homer Hoyt Institute and has created indices for the NACREIF institution, as well as taught broadly real estate finance across the industry at the likes of the Appraisal Institute and the CCIN organization, among others. Dr. Fisher has a wealth of knowledge to share and a limited time to do it, so without further ado, I will turn it over to Dr. Fisher and look forward to your remarks.
Thank you, Jeff, and I echo Jeff's good afternoon or good morning, depending on where you are. Again, the focus is on property analysis and DCF analysis. And I'm sure many of you remember the movie Jerry Maguire. And I always think of that when I think of discounted cash flow analysis, because what we're talking about is, what is the money? Show me the money. When we do a discounted cash flow analysis, it's all about cash flow. And when I see people making mistakes setting up models, a lot of times it's because they forget that basic idea that all we need to think about is how much money is going into the deal and how much money is coming out. So, focus of the webinar, it's going to be introducing the basic concepts and calculations behind DCF analysis, and that applies to both investment analysis and valuation. I think of investment analysis as calculating a return. Of course, there's other measures, and that return can be before tax or can be after tax, but the idea is, given a purchase price for the property, or it could be a construction cost, you know, what return am I going to get? Valuation is kind of doing that backwards. It's saying, well, given that investors want a certain rate of return, what should you pay for the property? So valuation estimates a value or what you should pay, a purchase price for the property, given the rate of return that would be required by typical investors in the market at that point in time. The models are basically the same. It's just whether you're going, you know, forward or backwards, starting with a purchase price and calculating return, or starting with a return and going back to get a purchase price. So to look at this graphically, kind of a timeline point of view of how you think about an analysis of a property. You've got a purchase price, and again, these, you know, we're starting off with basics today, so it's kind of simplified. It could be a construction cost, and you know, you could have some additional acquisition costs, but basically you've got, you know, some costs up front, a purchase price, and then you have cash flows over time. We'll talk more about what we mean by those cash flows, but we've got cash flows over some holding period, as we call it. Typical holding period for a discounted cash flow analysis is 10 years. Doesn't have to be 10 years, but that's kind of what you see when people do analyses in Argus and other software. And then you have some cash flow from sale of the property, which, you know, is called a reversion in practice, kind of an odd term for it. but that's basically referring to the cash flow you get from sale of the property. And again, as I say at the bottom, investment analysis is what return or IRR am I going to get given some purchase price. Valuation would be what purchase price, what value should be paid for the property to get an internal rate of return or IRR over time. So what do we mean by cash flow? And it's important, I think, when somebody's doing an analysis to make it clear what cash flow they're talking about. So it could be before tax or it could be after federal income taxes. Usually you see a before tax analysis, although if you take any CCIM courses, the focus is always on an after-tax analysis. It really depends on the nature of the investor in that particular property. If it's an institutional investor, that doesn't pay taxes, then you'll see a before tax analysis. But a tax-oriented investor wants to know, what am I going to get after taxes? It could be with or without a loan. A lot of times you'll want to see, well, how does the property do before bringing in financing and whether there's favorable leverage or not, and how I'm going to structure the financing on the property. The cash flow could be then to an equity investor that's investing on the property, or you could look at the cash flow to the lender. What kind of a return is the lender going to get on this deal? We're not going to do that today, but that's another way that you could analyze the cash flow. Or it could be the cash flow to just the land or just the building or to both. It could be a cash flow on a single property or even a portfolio of properties where you want to know what's the value of the entire portfolio or the return that I'm going to get on the entire portfolio. It could be based on existing leases, or it could be assuming market rents. If it's a valuation, say for property tax purposes, that's always on what they call a fee simple basis, which is assuming that all the leases are at market rents, even though the existing leases may be above or below market. And there's lots of other possibilities. So getting to the basics of how we would come up with the cash flows, you would start off with a rent. And again, this is kind of oversimplified, but it covers the basic things that you need to consider. What is the rent on the property? Is there any vacancy? And that takes you to what's called effective gross income. Then we would subtract any operating expenses, and these would be expenses associated with operating the property, such as property taxes and insurance, maintenance, utilities. It would include property taxes, but it would not include federal income taxes. So just expenses associated with operating the property itself. Once you subtract the operating expenses, you have probably what's one of the most important measures in real estate is the net operating income, the NOI, as we always just say. And a lot of times the analysis that we do will stop there, whether it's calculating something called a cap rate that we'll talk about here in a minute, or doing a discounted cash flow analysis. A lot of times you can just stop there and just understand that the rate of return that you get would be based on just using the net operating income and not considering the leverage that you'd have from financing or the tax effect. But just to see a complete picture of how you would go all the way to the bottom line of an after-tax analysis, after net operating income, the question might be, are there going to be any capital expenditures, replacement, of the roof, HVAC, those kinds of things? Now, sometimes those expenditures may be in a reserve allowance that's already reflected in your operating expenses, so you wouldn't want to double count. So there's always a question: is that NOI that I'm seeing on the property already considering some capital expenditures or not? But if they weren't considered in the operating expenses, then and again, in a discounted cash flow analysis, we want to know how much cash flow you're going to get. So if there's going to be money spent on capital expenditures, you need to account for that. Then if there is financing on the property, you would subtract what we call a debt service, and another kind of an odd term, but that's in commercial real estate we always say the debt service. That's just the principal and interest payments on the loan. Excuse me. Subtracting the debt service, we then have before tax cash flow, and then if you want to consider taxes, you would subtract the federal income taxes, and we'll go through a fairly simple example of how you would come up with the federal income taxes. But once you subtract the federal income taxes, you would get after-tax cash flow. Okay, I'll pause there for a second. Jeff, any questions come in so far?
Looks like we're all good, Jeff. Continue
Okay,
on.
good. Want to make sure I'm going at the right pace and not too fast or too slow. So there's also cash flow that you're going to get from sale of the property. And so that's the sale price minus any selling costs that you would have, brokerage commissions. And then that gives you a net sale price. If there's a loan on the property, you subtract the loan balance. That gives you a before tax cash flow. And then if there's federal income taxes, or you want to take into consideration federal income taxes, you subtract that, and that gives you an after-tax cash flow. This might be a good time to mention that all these slides will be available. We'll give you the link to the slides and to some spreadsheet examples that I've put together, so you can download them and go back through the slides at your leisure, as well as the spreadsheets that I'm making available. Some key ratios, and I've picked the ones that I think that are the most important, and I think I can show you, in what might be called a case study that we'll look at briefly later on, where these show up in the way an underwriter or a rating agency would look at a property. They're going to look at the cap rate on the property. I mentioned the NOI as being one of the most important measures. The cap rate is, another really important measure. Cap rate, which I'm sure you've all heard about, just taking the net operating income divided by the purchase price. Now, when I say that, you might get that from comparable sales. In other words, if you want to know what cap rate people are paying currently in the market for property, you look at what other properties are selling for, and if you can find out the net operating income on those properties and divide it by what it's sold for, you would have the cap rate from your comparable sales. And that's one of the ways that we value property before even doing a discounted cash flow analysis. Just, what cap rate are other people paying for properties in the current market? So again, NOI divided by the purchase price or the sale price of comparable sales. There's companies like Real Capital Analytics that make cap rates available on everything in the country over $2.5 million. So lots of different sources of cap rates, CoStar and others. RealNext has cap rates on properties. So a lot of sources of cap rates. Another important measure is the cash-on-cash return. Sometimes, like in the Appraisal Institute, they call it an equity dividend rate because it's the cash to an equity investor. And it takes that net operating income, subtracts the debt service, again, that's principal and interest payments, and then that is divided by the amount of equity that goes into the property. So the purchase price minus your loan is the amount of equity that's invested in the property. So you can see why it's called cash on cash, because at least before taxes, the numerator is cash that you're going to get, and the denominator is cash that you've put into the property. So you're taking the cash that you're getting divided by the cash that goes in. Now, all these things can be made more complicated. Like going back to the cap rate, that NOI is, in theory, it's actually a projection of next year's NOI, but sometimes people use the current NOI. It might be last year's NOI. So you need to be careful when somebody says, here's what the cap rate is. Well, what NOI did they use? And as I mentioned on the previous slide, sometimes there's a reserve allowance in that NOI, sometimes there isn't. So even though it looks like a simple calculation, it seems like there's a lot of different ways that people end up calculating it. And then the third one on this page is debt service coverage ratio. That is something the lender is certainly going to look at. The debt service coverage ratio takes your net operating income and divides by your debt service. So it's basically saying, is the net operating income covering the principal and interest payment, and by how much? A typical or a guideline, or a very rough guideline for what a debt service coverage ratio should be would be 1.20, meaning that the net operating income is 20% more than your debt service. But that's going to vary by property type. For a hotel, it's going to be higher. As many of you saw during the financial crisis, lenders required higher debt coverage ratios on properties, and so it varies depending on the market and the property type. But it certainly needs to be greater than 1.0, because if it's 1.0, you just have enough NOI to cover your debt service. And although the borrower may say, well, I'll cover any negative cash flows in the future, not what the lender wants to hear. So, in fact, a lot of times the amount of loan you can get is based on the debt coverage ratio. On commercial property, you can't necessarily just say, well, look, I'm putting in 30% of the equity. You're only loaning 70%. Therefore, what's the problem? Well, the lender wants to know that the property itself can cover the mortgage payment, and that the borrower is not going to have to reach into their pocket. Even though there's equity in the property, they don't want to have to foreclose to get their money back. So the debt service coverage ratio is really important from the lender's perspective. I added this just to give you a perspective of what cap rates look like over time. And there's a story here. I don't want to get too detailed, but this starts in 1978. The 4 after each of the numbers is just because this is quarterly data, and it's every fourth quarter that it's graphed by, or at least in the labels at the bottom. So it starts at 1978 and goes through 2015. And you can see how cap rates rose during a recession that we had in the early 90s. Then we had the nice recovery and drop in cap rates up until about 2008. I suspect most of you, if not everybody, knows what happened in 2008. As we went into the financial crisis, no surprise, cap rates went up as risk premiums were added to properties and values fell. Although it's kind of interesting that cap rates only rose to what would be a 20-year average for cap rates. And then if you look at where cap rates are now, this is on institutional properties, an organization that I've worked with called the National Council of Real Estate and Investment Fiduciaries that collects data from J.P. Morgan and Morgan Stanley and Prudential Real Estate and CalPERS and CalSTRS and all the different large institutional investors and pension funds. So it's institutional property, but they're buying properties at only a 4.5% cap rate right now on average. This is all property types combined, whether it's office, retail, industrial, or multifamily. So you can see cap rates are at all-time lows. The big question, which I want to try to answer today, is what's going to happen to cap rates over the next year as interest rates are expected to rise, and we have a new administration coming in, and lots of changes that will affect different property types in different ways. That can be a webinar all on its own in terms of how the new administration could be impacting real estate. But a lot of people are saying cap rates are probably going to go up. It's hard to say, but certainly they're at an all-time low. So some other important measures which are important for the discounted cash flow analysis would be a present value of the cash flow. So this is where you have to say what discount rate, which is just the rate of return that investors want, what discount rate do I want on the property as an investor, or does the typical investor want, and then use that to calculate the present value of those future cash flows. I'll show you an example in a minute. So at this point, just think about the fact that we want to know a present value of the cash flows, which is basically what I should pay for the property. Like I say, when we calculate the present value, it ignores the purchase price, and so it's telling you what you should pay for the property. It's an estimated value. The net present value is, as the word net suggests, it's net of the purchase price. In a sense, it tells you how much more you could have paid for the property, or might be willing to pay for the property. And then the internal rate of return is the rate of return that you would get based on the purchase price or some assumed price that you would pay for the property. It essentially is a discount rate that makes that net present value equal to 0. In other words, it makes the present value of all the cash flows exactly equal to the amount that you've invested. So let's take a real simple example. I've tried to boil it down to the minimum assumptions that you would need to do a discounted cash flow analysis on a property. But this is the exact same kind of thing that you would do even if it's a very complex property and you were using a program like Argus or RealNext Market Edge or some other discounted cash flow program to value property. It's just you'd have more details, but you still need each of these ingredients. You need to have some purchase price, unless you're estimating the purchase price of the property, as we've talked about. You would need to know what the NOI is going to be. Now, you might start off with rents and figure out what the operating expenses are and so forth. But ultimately, you need a net operating income on the property. Here I'm saying it's going to be $50,000 per year for the next 3 years. And then I'm saying it's going to increase to $55,000 due to some leases being renewed. And the point I'm trying to make there is, in a discounted cash flow analysis, you need to take into consideration lease renewals. Again, it may be more involved in practice, but the idea is you've got some income from current leases and you've got some income from lease renewals taking place in the future. And so your income could increase, could decrease, as a result of those lease renewals. And then I'm saying that the net operating income in year 6 is expected to be $60,000. Now, I'm going to come back to saying year 6 here in a minute, because you'll see in the next bullet point I say the property is projected to be sold after 5 years. So we're going to have a 5-year holding period, and we're going to estimate the resale price based on a 5% cap rate. When the cap rate is used to estimate the resale price, it's called a terminal cap rate, but this is just the same thing we talked about earlier. A cap rate is the NOI divided by the value, except what we're going to do is we're going to use that cap rate and apply it to the net operating income to get a value, which is going to be the resale price. Okay, I know there was a lot in what I just said, so let me back up to year 6. So you might recall earlier I said that in theory a cap rate is based on next year's net operating income. Okay, so if we're going to sell this property at the end of year 5, we're selling it to an investor that's going to look at the income when? In year 6, because year 6 is the first year of income to that new investor. So the way it's typically done in practice, whether it's an Argus program or a RealNext Market Edge, is that program will say, do you want to use next year's NOI, and that's usually the default. We're going to use next year's NOI, in other words, the year after we sell the property, the year after the holding period that we put in. We're going to apply a cap rate to that net operating income to get the resale price. So it's kind of a shortcut way of getting a sale price. It's like we're going to be pretty detailed on what our income is going to be for, let's say, the next 5 years, or it could be 10 years. But then we're going to say, look, my crystal ball is not that clear. What I'm going to do is kind of a shortcut way of estimating the value at resale by using this concept of a cap rate. Typically, the way that's done is to look at what cap rates are today and then to add something to that to say, well, what do I think an appropriate cap rate will be 5 or 10 years from now, which is kind of tough right now because, as we saw earlier, cap rates are at a historic low. So you have to ask yourself, when a property is going to be sold 10 years from now, are investors 10 years from now going to be looking at that low cap rate, especially if interest rates are higher, and also the property is going to be older, and I'm not that good at estimating what income is going to be 10 years from now, or even 5 years from now maybe. So do I want to use a little bit higher terminal cap rate than what cap rates are today? So those are the kind of things that an investor would be thinking about when they're trying to decide what the terminal cap rate should be. So here I'm going to use 5%. It's a little bit higher than what we saw in that chart as where cap rates are today. Not that I'm trying to exactly mimic current market conditions, but those are the kind of things that need to be taken into consideration in thinking about a terminal cap rate. And then finally, investors are requiring a 7% rate of return. That would be the IRR, the rate of return they want on an average annual basis over the, in this case, 5-year holding period. Okay, so hopefully you've absorbed the assumptions. Let's take a look at that in a spreadsheet. So again, these Excel spreadsheets will be available for you to download. Not that they're all that great, but something to start with if you haven't done this before. So I've got a discount rate at the top. I've got the terminal cap rate that we talked about, 5%, used to estimate the resale price. I've got my net operating income, 50 the first year, 50 the second year, 50 the third year, then it jumped to 55 for years 4 and 5. You notice the 60,000 out there because, as I said, we're going to use that to estimate the resale price. So you see the way I'm getting the resale price is to take that $60,000 in year 6, divide it by the terminal cap rate of 5%. That gives me $1.2 million resale price. So for year 5, I'm going to add that to the net operating income to get the cash flow. So my cash flow, and again, this, as I said earlier, cash flow can be before tax, can be before financing. So this is a before financing, before tax analysis. This is what I see all the time from institutional investors. Your large institutional investors typically, not always, but oftentimes buy all cash and they don't care about taxes. So basically, what's the NOI? What's the resale price? That gives me some cash flow. Every analysis that I've seen has used this approach of a terminal cap rate to get the resale price. Then you calculate the present value. So without going into a lot of details of what the present value, how it's calculated by discounting the cash flows each year. What I'm showing you is that, hey, in Excel, just use the NPV function. Now, it may look odd that I'm using a NPV function because I said the net present value is net of the purchase price, but that's the function that's in Excel that's available to us. The PV function is just for a single cash flow, so I have to use the NPV function, but you'll notice that I'm saying the NPV of cells E2, well, E2 is the discount rate, so I'm saying give me the NPV using a discount rate that's in cell E2, which is the 7%, but then the cash flows in cells D8 through H8. Okay, so you can see that D8 through H8 are the 50,000, 50,000, 50,000, and so forth, and the cash flow including the resale. So I'm not including a purchase price in those cash flows, so what Excel will do is just give me the present value of those cash flows. So even though I'm using an NPV function, it's giving me the present value of the cash flows. That gives me a present value of $1,067,973. I'm saying the purchase price was $1 million, so that gives me a net present value of $67,973. So you could interpret that as that's how much more I could pay for the property. Of course, if you're the buyer, you're not going to tell the seller, hey, I could pay $67,973 more, but hey, this looks like it would be a good deal if I'm willing to buy this property at a 7% rate of return. I'm getting more than a 7% rate of return. We'll get to that in a minute, but I'm getting more than a 7% rate of return if I can buy the property for $1 million because the present value is $1,067,973. If the seller comes back with a higher amount, then well, I'm willing to go up to $1,067,973, and but I got to stop there unless I'm willing to give a little bit on the discount rate. And then finally, we talked about again cap rates and how important they are. What I'm going to now do is say, well, what is the cap rate implied by that present value of $1,067,973? So if I take the net operating income in year one, the $50,000, and I divide that by the value of the property, okay, and it looks like the reference there is wrong, but what that is taking the net operating income in year one and dividing by that present value number, and that gives me a cap rate of 4.68%. So 4.68% is the implied cap rate that I'm paying for the property. So I'd want to know, is that in line with what other people are currently paying in terms of cap rates for property? Even though I just did a discounted cash flow analysis, maybe I'm comfortable with that result. I'd also like to make sure that that implied cap rate of 4.68% is also in line with what other people are currently paying for properties based on the year one net operating income. I'll pause again. I notice I got going instead of a going in cap rate there. A little misspelling here. I just noticed for the first time, but you get the idea.
Okay, Jeff. I think so your point is the E3 in that cell when the going in cap rate should be actually the purchase price of
Right.
D11.
Right.
Yeah.
Right.
So for anybody watching, so it's actually D6 divided by D11. We'll make that update in the
We'll fix that before you download it.
And we're good to go. No questions for you. Just continue on.
All right. Okay, so again, we've done kind of a simple analysis, but these exact same steps, plus a few others, would be involved in any kind of a discounted cash flow analysis. So moving on to taking the same example but calculating an IRR. For an IRR, we're going to use the exact same cash flows, but we're going to put in our purchase price. So now we have the $1 million in there, and we now just again use an Excel function that says give me the IRR of what's in cells D8 through I8. Okay, so now we're including the purchase price in those cash flow cells. So I've got the $1 million in there along with the the NOI that we've already talked about and the resale cash flow that we've already talked about. And what Excel does is say, hey, if I take the present value of each of those cash flows at an 8.55% discount rate, that's going to make it equal to exactly the $1 million that I'd be paying for the property. So based on $1 million, as we said, it's got to be higher than the 8% that we talked about earlier. Actually 7% in this case. At a 7% rate, we knew we were getting a higher rate of return because of the positive NPV. The actual return is 8.55%. Okay. And then we could add a loan to the property. So if we add a loan to this exact same example, so I'm taking the same example and just saying, well, what if we put a $750,000 loan on the property at a 6% interest rate, and to keep it simple, I just made it interest only. So our debt service is just interest payments in this case. If it was a loan being amortized, you know, of course, the payments would be a little bit higher than you would get based on just the 6% interest. So all that means is, in order to get the cash flow, I need to subtract that debt service, and when I sell the property, I need to subtract the loan balance. So all that's been added to the previous example is the debt service, paying off the loan at the end, and of course our investment is lower. So now we're only putting in $250,000 because we borrowed $750,000 from the bank. The bank is getting a 6% return out of this deal, and we're getting, it turns out, a 14.6% rate of return. Of course, it's higher now due to the leverage, because what we've done is we've taken a property that's earning an 8.55% rate of return, and we borrowed money at 6%. So we take 8.55% that we're earning before the loan. We're saying to the bank, give us 75% of the money at a 6% rate, and that levers our rate of return on equity up to 14.6%. Of course, we're taking on more risk because the bank gets their money first, and if anything goes bad, it comes out of the NOI. The bank is, for some reason they still want to get their $45,000 in this case, so it does come out of our pocket. So even though the return is higher, of course the risk is higher, but this is the way leverage works. And in this case, it's favorable leverage. Leverage can also be unfavorable and work against you, but normally going into a deal, you wouldn't do it unless you expected the leverage to be positive. I've also added taxes to this example. I don't think we want to go into the details of this. Maybe in a more advanced seminar, if there's webinar, if there's interest, we can spend more time on some of these things. But basically, the idea is to go to an after-tax analysis. You have to know the breakdown between the land value and the building value, because only the building can be depreciated. You have to know what the tax rates are for the investor. So in this case, we've got an ordinary income tax rate and a capital gains tax rate, and then the current tax law requires any depreciation that you took each year for tax purposes to be recaptured. They call it at a 25% rate when you sell the property. So basically the idea is, we now have to calculate the taxes each year. And actually it turns out in this case the taxable income is negative. We've got a $50,000 income. We subtract our interest of $45,000, which is tax deductible, and then we can depreciate the property over 39 years. So I assume that's commercial property. Depreciate over 39 years. Hopefully Congress won't mess with that. And then that gives us a taxable income which is negative. Check with your tax accountant, but if you have other, if this is considered passive losses for you, you'd have to have other passive income, otherwise carry it forward. We won't get into all the details, but if it does turn out that you can use those losses against other income, that's sheltering other income, which is always a good thing. So if we go to the bottom line of the after-tax analysis, you'll notice that the IRR is 13.43%. It's not that much lower than the before-tax IRR. If we go back to the before-tax IRR with leverage, it's 14.6. Now we're just dropping to 13.43, and that's because of the benefits of the depreciation, the lower capital gains tax rate. Even with that depreciation recapture, what we've done is we've deferred income for 5 years, and so we don't have to pay taxes on that deferred income from the depreciation until we sell the property. And of course we could do tax-free exchanges and all that kind of stuff to defer taxes even more. So that's a whole other topic that we could talk about is how that works. But these are the basic ingredients of an after-tax analysis. If you were taking a CCIM course, you would spend a lot of time talking about how to do an after-tax analysis on a property. And that would include learning how to do the taxes from sale of the property, which is figuring out how much your gain is. Your gain on the sale of the property is basically how much it increased in value and what depreciation you took, which was pretending like the value was going down over time when it really wasn't. And so when you sell it, you've got a $200,000 increase in value, and you took a little bit over $100,000 in depreciation deductions. So you've got a $300,000 capital gain. Those are taxed at different rates as shown here, and that gives you your tax. But let's go on to an example to try to reinforce the different measures and concepts that I talked about. So this is an actual 24-hour fitness center property, something I could use. And you'll see that it has a loan. It's a retail property, single tenant. Of course, it's in Pleasanton, California, 56,000 square feet, 100% occupied right now. And the reason that I had the information on this property is because it was in a summary of data that is from Fitch that was doing an analysis of this property for it being put into a CMBS, and where they had to come up with a rating on the property. So this loan is being put into a commercial mortgage-backed security, and so they did an analysis of it. And so you can see that there's information there on what the interest rate is going to be and what the loan term is going to be, and how it's going to be amortized. Got some information on the loan balance. It's a $16.3 million loan. It's been appraised at $28 million, and it's got a net cash flow of $1.7 million. Okay, so there's that debt service coverage ratio I told you is important, 1.82. So from their perspective, they got 80% more net operating income they needed to cover the mortgage payment. So they're going to conclude that investors, at least in the top-rated securities in the CMBS, are going to be very safe. It's only a 58.2% loan-to-value ratio. This is a cash flow analysis that they did. It has the historical cash flow on the property, 2013, 14, and 15. And then you'll see next to the last column, there's a Fitch cash flow analysis. And what they do is they stress the property. They say, well, even though this is 100% occupied, what if there really is some vacancy? Of course, on a single-tenant property, it's either all or nothing, right? But still, the underwriters, the rating agencies like to, throw in, they like to be very conservative and say, well, what if there's some vacancy on the property, and what if there's additional capital expenditures? You'll notice they threw in capital expenditures in their analysis that, weren't actually in any of the financial statements in 2013, 14, or 15. So they're being very conservative and coming up with a lower cash flow than was actually being generated by the property each of those years. But I guess what I wanted to emphasize is these are the same things we talked about. You start off with a rent, you have your expenses, you have any vacancy, there could be some sources of other income, and then you get an effective gross income, and then you have your operating expenses. Here they broke it down into fixed and variable, which is variable means it varies with your occupancy. But these are your operating expenses. Then you have your net operating income, subtracting any capital expenditures that you might have. You have your cash flow. So exact same types of things that we talked about in the real simple example that they're doing in their analysis of the property to actually underwrite this loan to go into the commercial mortgage-backed security. And then they have their projection of the cash flow. This is just a little bit more detail of what we just saw in a spreadsheet that they also provided along with their analysis of a property. And again, the same variables that we talked about taking us down through the net cash flow on the property. So next thing I did was I took that same property and using the RealNext Market Edge, just as an example of how you could take that same information and put it into a software program that it's designed to do this kind of discounted cash flow analysis, so you don't have to use spreadsheets. It'd be the same concepts whether it's Argus or some other program. just using the RealNext Market Edge as an example of a program that can do it. By knowing the address, it can automatically pull up a picture on the property. And so we're going to look at the 24-hour fitness center property that's on the left there. If you're really glutton for punishment and want to buy my textbook and learn more about how to do this stuff, there's actually some textbook examples that the files are available to you for this same program to pull in the textbook examples and see that you get the exact same answer as in the textbook. But let's take a look at this 24-hour fitness center property. So putting the basic information that we saw from Fitch into this program, what I've done is just made a few additional assumptions. That there was nothing in the information from Fitch on what was going to happen to rents in the future. So I assumed that they would, because they had been increasing through time, I assumed a 2% growth rate in the rents. And then I went along with Fitch and went ahead and put in some vacancy into the property, although, again, it doesn't look like there's any reason there should be any vacancy since it's 100% occupied, by the fitness center. But again, you see the same format. You start off with your rental income, you subtract your vacancy, subtract your operating expenses. That gives you your net operating income. And then I did put a loan in the property, and I put some tax information in, like we saw before. So you've got your loan, you've got your capital expenditures, and I went with Fitch's assumption that there would be some capital expenditures, and that gives you your cash flow. And here's one of the returns we talked about earlier, cash on cash. So you're getting 5% cash after the loan payment divided by how much equity you're putting in the property. So about a 5% cash on cash return. That seems pretty reasonable. Let's go ahead and look at the financials. And so you see the cash flow, the resale proceeds each year, how much capital is invested. Let's look at your IRR, which is calculated each year, but you're kind of hurt if you sell it just after a year because of selling costs and not giving the property a chance to have those rent increases. But when we get out to year 5, you see a 9.13% internal rate of return. Now whether that's good or bad depends on current market conditions and what you can do on other properties, but that's kind of a bottom line of this type of discounted cash flow analysis is, again, show me the money. On cash flow, I'm getting a little bit over a 9% rate of return. The modified IRR, kind of beyond this webinar, has to do with making assumptions about how you can reinvest your money. I might point out the bottom line, present value, it says PV and then NOI plus reversion. That's kind of a long way of saying that's an estimated value for the property. So that's saying if you're going to hold this for 5 years, you should be willing to pay $25 million for the property. So gives you an idea how you could use a program like the RealNext Market Edge to do this exact same type of analysis. Here's another summary of some financial indicators. The gross rent multiplier. We didn't talk about that, but that's just taking your property value or your purchase price in this case and dividing it by what the rent would be before even subtracting any expenses. For, as many of you I'm sure know, for properties like apartments, a lot of times a gross rent multiplier is a good way to get at least an initial value of what the property might be worth. And then here's your old capitalization rate again. So you see what that would be each year based on the NOI that year. The cash on cash return, which is done on a before tax and after tax basis. The debt coverage ratio, just like we saw before, 1.71 on this property going in the first year. So, lenders should be happy with that. And then some other measures down through, what the loan to value ratio is and operating expense ratio and so forth. So a summary of kind of the key things. There's other things I could have shown you, like a lot of different charts that you can get and the details of the cash flow on each lease and so forth. That gives you a general idea. And I think we're running out of time, so I knew we wouldn't be able to go through these slides here that are additional considerations and a lease-by-lease analysis. So I put these in more for those that want to kind of go back. This is kind of reviews what we've already talked about, but some additional things you need to think about if you're really using a program like RealNext Market Edge or Argus or some other program where you had to think through some additional assumptions and think about what the holding period should be and how to think about projecting income from existing leases and if it's other income on the property. And then, thinking more detailed about your lease renewal assumptions, your vacancy assumptions, your different types of expenses, whether there's capital expenditures on the property, your loan information, discount rate, how you really come up with a discount rate for the property, and the tax information, and estimating the resale price. So we have a more advanced webinar at some point. If there's interest, we can drill down even further into some of those things. So where can I go from here? Assuming that we're hoping that you found this interesting, you can use the Excel examples and you could try to expand those. It does get a little bit complicated using Excel when you have a lot of leases on a property. Not that Excel still isn't used, especially for apartments, even by some fairly sophisticated investors, but once you get beyond simple properties, you probably want to use some software like a RealNext Market Edge. I like RealNext and put it in my textbook because it's cloud-based and all you need is a web browser. Just go to www.realnext.com and you can do what I was showing you earlier. And then if you're interested in my textbook, not trying to sell textbooks, but just Google real estate finance and investments and you'll find it on Amazon and other sources. And I do have examples of using the RealNext Market Edge in the textbook. And then everything from the webinar today is at this final URL. So info.realnext.com/FisherFinancials. Give us maybe a half an hour to fix that one thing that, well, give us a couple hours just in case to fix that one cell reference, although it was probably pretty obvious what needed to be fixed there. And you'll be able to download everything. It's actually there right now, but we want to fix that one thing. And I think with that, I'm going to turn it back to Jeff unless there was some questions.
That's outstanding. Perfect, Jeff. Thank you very much. We really appreciate your time today and sharing with us. It's a fountain of information, a lot to cover in a short period of time, and obviously a lot more to cover. We'd love to hear from the audience. If you'd be interested in a more advanced session, please send us a note and let us know what you think about the level of this program as well as what you might want to see in the future. Certainly,
Jeff,
we have
the survey that they're going to get. I think in the survey they're going to get. That's one of the questions that we added. Is there if they're interested in some more advanced webinars?
Perfect. That'll be coming. Look through the survey and please give us your response. We value that information and feedback. We do have a demo series, so RealNext is available to you to help facilitate and streamline the process as Jeff indicated. So every week there is a series of demos set up. Go to realnext.com and you can sign up for the demo series to get a deeper dive into the Market Edge platform as well as to learn more about our full deal automation with our CRM and transaction management and marketing engine so that you can take advantage of the full suite. We'd love to show you our products and see how it can help streamline your business. We're really excited that at the end of the month we have a new mobile app coming to the market which will help put the power of the RealNext solution in the palm of your hands. Please look for it, try it out, and hopefully you can benefit from the power of RealNext in our technology that's behind the deal in supporting you in your business. That's it for today. We do invite you back for the next session of the RealNext webinar series. This is a totally different side of the business, but one that's more important today than ever. It's social media. How do you take advantage of social media and put that into your business plan and make it part of your strategy to build your brand, build your awareness, and build your book of business? So please look for details on that and join us back in 2 weeks as we bring that webinar to you. So thank you once again for joining. Thank you, Jeff, and we look forward to sharing more information in future webinars. Have a great day.